In 2006, Douglas Zalesky, a successful trader, published the 25 Rules of Trading Discipline. I thought it might be an interesting idea to review his list in this video. So I grouped these into thematic elements, and so while it might seem like it's out of order, it's actually a deliberate thought process. Zalesky's advice is primarily intended for technical traders, so keep that in mind if you focus more on fundamentals in stock investing. But nonetheless, chances are that it can help you understand and identify your own emotions. And if this interests you, then please keep watching. Discipline. Discipline is the practice of training people to obey rules or a code of behavior using punishment to correct disobedience. The first set of rules revolves specifically around discipline. The market pays you to be disciplined. The thought is that trading with discipline will ultimately mean more money in your pocket than money leaving your pocket. Be disciplined every day in every trade, and the market will reward you. But don't claim to be disciplined if you're not 100% of the time. I think of this as being consistent, even on a diet. Overall, cheating on a diet every day interferes with consistency and results. Especially in trading, if you trade with discipline 9 out of 10 trades, and then the one undisciplined trade could potentially hurt your overall performance. So therefore, practice discipline on every trade. Develop a methodology and stick with it. Don't change methodologies from day to day. Zalesky suggests traders actually write down the specific market prerequisites or setups that might take place in order for them to make a trade. He wants to ensure that they have a set of rules, market setups, or price action in order for them to take the trade. So make a game plan. And some days your plan might not work, and that's okay. If your methodology works more than one half of the trading sessions, then the advice is to stick with it. You always want to be able to come back and play the next day. Once you reach your daily downside limit, you must turn off your computer and call it a day. You can always come back tomorrow. So this means set a plan and then stick to your plan. Consistency builds confidence and control. So if you play by the rules, trade with discipline, and stick to your methodology, the probability of a successful day is high. Just by making a little bit every day, you will allow your trade throughout the trading session with confidence and control. Make the same types of trades over and over again. Be a bricklayer by laying each brick by brick. Luck. Always lower your trade size when you're trading poorly. All good traders follow this rule. If you keep striking out when you're up for batting, reduce your trade size. Then when luck is on your side again, such as after 2 consecutive winning trades, raise your trade size. Hit singles and not home runs. Try not to approach a trade with the idea that it's going to be a home run. Home runs are mostly luck and not skill. All traders are created equal in the eyes of the market. Everyone starts out at 0, and once the trading begins, your conduct and discipline will dictate whether or not you will make money on that day. Greed. Never turn a winner into a loser. I wonder how many traders have actually mastered the art of exiting a trade at the right time. Some people hold on to a winning trade in the hopes of even more gains. Unless you have some sort of a fundamental reason to believe the stock will rise, there is the risk that the market will turn and move against you. Don't get greedy. Earn the right to trade bigger. Remember, if you're trading poorly with 2 lots, you must lower your trade size down to 1 lot. This just means that you should master smaller trades before making larger trades. Training counts. You might be asking, side note, what is a lot? A lot in the financial market is the number of units of a financial instrument bought on an exchange. The number of units is determined by the lot size. So for example, in the stock market, a round lot is 100 shares. But lots don't have to be round or 100 units. That's just an example. Don't speculate. If you do, you might lose. Speculating trading means a trader makes a financial transaction that has substantial risk of losing value, but also holds the expectation of a significant gain or other major value. Trading is rather about short-term scalping of the markets. The probability of a winning day or week is greatly increased if you trade short-term, small winners and even smaller losses. Make a little bit every day. Dig your ditches, don't fill them. When Zalesky was a young bond trader, his goal every day was to make 10 bond ticks. Each tick is $31.25. And so if you made 10 ticks on the day, you would be up $312.50. Maybe that's not a lot, but if you could make 10 bond ticks every trading day of the year, at the end of the year, he would be up $72,500 in his trading account. Your trading account will build up over time just by making a little bit every day. Losing. The next set of rules are about losses. Your biggest loser can't exceed your biggest winner. Make sure you are net positive at the end of the day. A good way is to keep a trading journal. Your losses should not be higher than your winners. Get out of your losers. Zalesky's typical trade day consists of a 33% losing trades, 33% scratches, and 33% winners, and he exits his losers very quickly. The first loss is the best loss. Exit a bad trade quickly, learn from it instead of brooding about it, and move on. Don't hope and pray. If you do, you will lose. Look, we're not questioning your right to have faith, but divine intervention isn't going to help you out on a bad trade. Just get out of the trade. Love to lose money. He does suggest that it's wise to simply accept that you're going to have losing trades and exit your losers quickly. Love to have the discipline and foresight to get out of your losers quickly. In the end, it will save you a lot of trading capital and it will make you a much better trader. Never take a big loss. Only a big loss can hurt you. If you don't violate the aforementioned rules, you probably won't violate this rule. Big losses wipe out your small wins, and they can also cause a lot of psychological and emotional damage. Imagine losing $25,000 in a trade, just like that. It could take a long time to get back your confidence after taking such a big loss on a trade. Signals versus noise. Be yourself. Don't try to be someone else. Figure out your trade size, comfort zone, and don't try to mimic others who might have different experience levels and different comfort levels. Don't worry about the news. It's history. Avoid financial news TV such as CNBC, MSNBC, Bloomberg News, or FNN all day long. Zalesky suggests the talking heads on these programs know very little about market dynamics and market price action for technical traders. And in any case, financial news from TV is already old news by the time it airs, so avoid trading on it. One caveat is that Twitter can actually be very close to real-time information, but again, be careful about whose tweets you consume and act on. Don't overanalyze, don't procrastinate, don't hesitate. If you do, you will lose. You don't get paid in trading unless you actually trade. So don't overanalyze the trade. Place the trade. If you're wrong, exit the trade. But you have to be in the game for anything to actually happen. Sell. If your trade is not going anywhere in a given time frame, it's time to exit. Where there is an oversupply or imbalance of buy orders, it will push the market up. An oversupply of sell orders will push the market lower. When price remains the same, the market and its participants are saying they're satisfied with the prevailing bid and offer. Don't trade during these times. Wait for the market to have more activity and then place your trade. Learn to sweat out or scale out your winners. This could also fall under discipline. If your trade size is more than one lot and your trade is a loser, exit the entire position. If your trade size is more than one lot and your trade is a winner, it's best to exit half of your position at your first target price. Justice. It's the market itself that wields the ultimate scale of justice. The market does not care about anyone in particular. The market does not play favorites, and neither does it discriminate. The market does not intentionally harm anyone. The market is always right. Respect the market. The market will mercilessly punish you if you do not play by the rules. Learn to condition yourself to play by the 25 rules of trading discipline, and you will be rewarded. Pat yourself on the back if you made it to the end of this video. If you like this content, please click the like button and subscribe to this channel. I think I'll have to make a video on how to do some more technical trading in the future. Thank you very much for watching, and hopefully we'll see you in our next video.